Welcome to the world of economics, dear learners. Today, in lesson 8, we shall be studying about cost and revenue. Cost and revenue, as we all know, is what a producer has to consider. We shall learn about the meaning of cost, the definition of cost, types of cost, total and average cost, and compare marginal cost and average cost, and then we shall be moving on to revenue by defining revenue, understanding average and marginal revenue and comparing the two, and then understand how a producer uses revenue and cost. A producer has to work very hard to produce a good or service. He has to make a lot of effort in the process. In the beginning, the producer must arrange money to organize the production activity. We have already said that various factors in the form of land, labor, capital and entrepreneurship are required to produce goods. These factors are not available for free. The producer must purchase them in the right quantity needed for production. In the same manner, raw materials and other things have to be purchased and stored. To purchase these, the producer must be ready to pay the price for them. Where does this money come from? Once the goods and services are produced, the producer sells them in the market to various consumers. At this time, the consumers pay a price to the producer to purchase the goods and services. With this, the producer starts earning money. So, in order to produce goods and services, the producer first incurs expenditure to purchase the factors of production and raw material, and then receives money from the consumers by selling those goods and services to them. This is a continuous cycle of production. Let us now understand the meaning of cost. In order to understand this, let us take the example of a farmer who is producing rice or paddy. It normally takes 5 to 6 months to produce rice. The production of rice involves the following: getting the land for cultivation, using labor to prepare the land and make it suitable for growing the crop, which includes tilling the soil, sowing seeds, fertilizing and irrigating the land, and finally harvesting it. And it also includes transporting rice to godowns or the mandi or the marketplace. How does the farmer get land? It could be possible that the farmer has ancestral land. Otherwise, he has to hire land from others by paying rent. He has also the option of purchasing land by paying a very heavy amount for it. In an example that I am going to take you through now, let us say that the farmer hires 5 acres of land on rent, and suppose he has to pay rupees 5,000 as rent to the owner of the land for the whole period he uses it. The farmer also needs laborers to work on the field for 5 months. Let us say the farmer hires 4 laborers who in the first 2 months till the soil, sow seeds, transport the seedlings and plant them by hand, fertilize and irrigate the field. In order to hire a laborer, the farmer has to pay some wage. The wage rate prevailing in the market on an average is say rupees 75 per worker per day. When the farmer used only 2 laborers for 2 months to look after the standing crop, then the time of harvesting arrives, he again hires 4 laborers for 15 days. What is the total amount paid to the laborers by the farmer? Since the first 4 laborers work for 2 months or 60 days and at a wage rate of 75 rupees per worker, it comes to be 75 into 4 into 60, which is 18,000. Then the 2 laborers work for 2 months. This comes to 75 into 2 into 60, which is 9,000. And finally, the 4 laborers work for 15 days, which comes to 75 into 4 into 15, which is rupees 4,500. Adding the 3, as you can see on the slide also, it gives us a total wage payment of rupees 31,500. Hence, to grow the crop, the farmer uses raw material on which he spends about rupees 3,000. He also uses tractor for which he pays a rent of rupees 2,500. After harvesting, the farmer produces 30 quintals of rice. Now, let us calculate the total money spent by the farmer to produce rice, which is 30 quintals of rice. This can be done as shown on your slide in the following manner. You can see the table that the farmer pays rent for 5,000, wages which we have calculated 31,500, raw materials which is 3,000, service of tractor which is 2,500, which comes to a total of 42,000 rupees as cost for 30 quintals of rice. This is the farmer's cost of production. Now, let us understand cost and how we can define it. Cost is defined as the money expenditure incurred by the producer to purchase or hire factors of production and raw materials to produce goods and services. In a way, cost is a kind of a sacrifice made by the producer. In this example, the sacrifice was made in terms of making payments such as wages to laborers, rent for the use of land and tractor, and purchase of raw materials, etc. You know, there are different types of costs. Costs can be classified into, first and foremost, fixed costs, second, variable cost, third, as explicit cost, and fourth, as implicit cost. Let's discuss them one by one. In the above example, we said that the farmer paid rupees 5,000 as rent to the owner of the land. Once the land is procured for cultivation, the farmer must pay rent, even if he does not produce anything on it. The land is hence a fixed factor of production, because whether or not the farmer cultivates on the entire 5 acres of land, he has to pay rent for the whole 5 acres. This is fixed. So, fixed cost is defined as the expenditure on hiring or purchasing of fixed factors or inputs. These are compulsory and it has nothing to do with the amount of production of the good or service. Similarly, rent paid for the use of tractor is also a fixed cost. Let us now understand variable cost. In the above example, the farmer paid rupees 31,500 towards wage for laborers and rupees 3,000 for purchase of raw materials. How much depends on how many laborers the producer hired. Labor as a factor of production can be changed. In the example, we have just seen that initially the farmer used 4 laborers during the first 2 months and only 2 laborers for the next 2 months. This is because in the beginning the amount of work was more and more amount of money, that is rupees 18,000, was paid. But when the amount of work was less during the next 2 months, only 2 laborers were hired and accordingly the wage bill also decreased to 9,000. Hence, payment towards wages can be changed. So, it is called a variable cost. We can define variable cost as the expenditure on variable factors or inputs such as labor, which can be changed with production. Let us now understand explicit cost. Both the rent and wages paid by the farmer and the expenditure on raw materials incurred by him are all explicit costs. Explicit cost is defined as the money expenditure incurred by the producer on both fixed and variable factors of production and raw materials, etc. These are calculated and recorded separately and are direct payments. Bills, money receipts or vouchers etc. exist with respect to such expenditure by the producer. On the other hand, we have implicit costs. Besides purchasing factors of production and raw materials, the producer also uses his own factors and materials for producing goods and services. For these, he does not pay any money to himself, but he himself bears this expenditure indirectly. Supposing in the example above, the farmer was to use his own tractor to cultivate the land, rather than hiring it from someone else. In such a case, he would have paid rent for this, and this would have been, if hired from outside, called an explicit cost. But if the farmer himself is supplying this tractor, then the farmer is incurring an implicit cost. So, implicit cost is the cost of self-supplied factors of production or raw materials. The value of such cost has to be calculated on the basis of the market value available. Let us now go through the concepts of cost with the help of which we can measure various costs. These are total, average and marginal costs. Total cost is the sum of total fixed cost and total variable cost, which are given explicitly. Average total cost, or simply the average cost, is the ratio of total cost to the total output produced. This can be written as TC, which is total cost, equals to TFC, which is total fixed cost, plus TVC, which is total variable cost. Average cost can also be written as TC upon total output, or TC by Q. Average cost is also known as the cost per unit of output. If a producer wants to increase output, then he has to engage extra units of labor. Extra units of labor will lead to extra expenditure on wage paid to the labor. As a result, the total cost of production will increase. In short, increase in total output will lead to increase in total cost of production. In this context, marginal cost is defined as increase in the total cost due to increase in one extra unit of output. This has also been shown on the slide, along with taking the example of a tailor who makes 10 pieces of shirts by incurring a total cost of rupees 1110 rupees. When he increases the shirt production to 11 pieces, he also incurs more cost, and so his total cost increases to 1199 rupees. What is the marginal cost? That is the marginal cost of producing the 11th piece of shirt. So, here the output increases by 1 unit and the cost increases by 1199 minus 1110, which is 89 rupees. So, marginal cost of the 11th unit of shirt is rupees 89. In this example, while there is one value of marginal cost as calculated above, we can compute two different values of average cost. First value of average cost relates to 10 pieces of shirts. With a total cost of rupees 1110, AC equals 1110 divided by 10, which is rupees 1000, which is rupees 111. Second value of average cost relates to output of 11 shirt pieces with total cost of 1199. Here, when we divide this figure by 11, we get 109. From this we can say that average cost is calculated for every given level of output. On the other hand, marginal cost is calculated when a given level of output is increased by 1 unit. That is, marginal cost is calculated between two successive levels of output. Now, let us understand about revenue. Revenue is a producer's earnings. A discussion of cost is not complete if we do not talk about revenue. What is revenue? Revenue is the proceeds from sale of output that a producer receives. This sale of output depends upon the quantity of the commodity sold. So, revenue can be defined as the amount a person receives by selling a certain quantity of the commodity. We all know that a commodity can be purchased in the market by paying a certain price. So, revenue can be calculated by multiplying price per unit paid into quantity of the commodity, and hence we write revenue equals price of the commodity into quantity of the commodity. During a given period of time, the seller sells certain quantity of the commodity. So, the total amount of money received by the seller during that time period is called total revenue, denoted as TR. Let us denote price as P and quantity as Q. Then we can write TR equals P into Q. This completes our statement for total revenue. If we go back to our initial example of the farmer in our cost section, and we recall that 30 quintals of rice were produced by the farmer, and let us say that the price of rice is 1600 rupees per quintal in the market, and if all of this is sold by the farmer in the market, the farmer's total revenue is going to be 1600 into 30, which is rupees 48,000. From this example, we can also say that revenue is the money receipts of the producer or seller from the sale of his output. Another term used for total revenue is also total sales proceeds, because revenue is received by selling a commodity. It is also called total sales proceeds from that commodity. Let us quickly brush through average and marginal revenue. Average revenue, which is denoted as AR, is calculated from the total revenue by dividing total revenue with the quantity sold. Symbolically, as you can see, AR equals TR upon Q, and since Q is repeated in the numerator and the denominator, because TR is nothing but P into Q, we get AR is nothing but price itself. Average revenue and price of the commodity are hence one and the same. Marginal revenue is defined as increase in total revenue due to 1 unit increase in the sale of the quantity of output. In the above example, the vendor that we have shown increases the sale to 21 kg. In that case, the total revenue or TR becomes 50 into 21, that is rupees 1050. Earlier, when the sale of output was 20 kg, the total revenue was 1000. Hence, MR is 1050 minus 1000, which is rupees 50. If we compare AR and MR, we should be clear about two things: that average revenue is calculated for each and every given level of sale of output, while marginal revenue is calculated for two successive levels of sale of output. If you remember, we discussed the same for average cost and marginal cost. One important observation to be made from the example. We can see that if the seller is able to sell successive quantities of output at the given or same price, then AR and MR are equal. This further implies that if the price of the commodity in the market will change for different quantities, then AR and MR will be different from each other. This has again been dealt with in the example of guavas that was shown to you earlier. The average revenue from sale of 20 kgs of guavas is rupees 1000 when quantity is 20 kg. And it's worthwhile to note that price per kg for guavas is rupees 50, which is AR also. And if price does not change and more amounts of guavas are sold, then we can see that the AR remains the same and so does the MR. So, this explains that even if more guavas is sold, that is 21 kg, then also AR and MR remain the same, because AR, which is the price of the commodity per unit sold, does not change. Now, the pertinent question here is, how do we use revenue and cost? Both revenue and cost are important concepts in economics. While cost is the expenditure incurred to produce a good or service during the production process, revenue is the money received by the producer by selling that good or service. So, cost symbolizes sacrifice made by the producer and revenue symbolizes gains for cost. By getting the required revenue from sale of the commodity, the producer is able to recover the cost he has incurred earlier. In that case, we say that the producer earned his due share, which is called profit. So, we can define profit as the surplus of revenue over the cost of production, or in terms of total revenue, total cost, profit is nothing but total revenue minus total cost. I hope today's learning has gone far and it has been interesting with all the examples included, and do try and practice on your own as well, so that you can master the skill of calculating average cost, marginal cost, average revenue and marginal revenue. All the best and thank you.